Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to kick off another earnings season. Time seems to be flying and we are ready to look at earnings season again as a template as far as where equity markets can go. Markets had a pretty strong Q2 earnings season, so we're taking a look at what our expectations are for Q3, how we would generally utilize options to take advantage of any directional views that we might have on an underlying stock. And for those of you that are going to utilize options to trade earnings season, making sure that you understand what are the nuances and best practices for both the strategies and understanding how options pricing is affected around earnings. Those are really important things to understand before you execute these in your portfolio. So let's go ahead and get started. Now, before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we're going to start off with our Q2 preview and Q2 review and Q3 preview to give you a sense for how did S&P 500 stocks do on Q2 earnings? How did markets react to stocks that beat versus miss? That's a very important metric to track, and take a look at what our expectations for Q3 currently are. Then we're going to take a look at the type of option strategies that are suitable for trading earnings, whether you're looking to trade a stock that you think is going to make a big move on earnings or a stock that you think is going to be fairly neutral. Option strategies allow us to take a directional view going into earnings, but do it in a way with limited risk, because whenever we're trading earnings, this is really where most of the volatility of a single stock happens, is around earnings. So we want to make sure that if we are wrong on a directional view, that we're protected, and options really provide us with that ability to protect ourselves if the trade goes in the opposite direction that we expect it to. And in order for you to trade options around earnings, it's really important to understand how option pricing is affected around earnings, and really referring to what we call as volatility crush. Very important to understand that. We're going to take a look at the earnings calendar. This is something that we produce here at OptionsPlay. Our earnings calendar is focused on liquidity because, especially in the middle of earnings season, sometimes there could be a few hundred names that report on a single day. How do you know which ones you should focus on, especially if you're trading options? Our options current earnings calendar will tell you exactly which ones are the most liquid stocks to focus your attention on, and which ones are not liquid to hopefully help you avoid trading earnings or at least options on those underlying stocks. Then we're going to try to go through as many examples as possible to show you the strategies they're referring to, and at the very end, we'll open this up for Q&A. But the primary question that I want investors to be able to walk away from today's session and understand how to trade is really, how can you trade the upcoming earnings season with limited risk? And the key word here is limited risk, utilizing options. So that's what we're going to explore here today on our session. Now, my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And what I want to make sure that everyone understands today is really the nuances of options trading around earnings, because once you learn the fundamental building blocks of options trading, it really comes down to deploying these strategies during times like this, where you're going to be able to take what you've learned and apply them to the markets, specifically around limited risk strategies. So we're going to go over a few different limited risk strategies and show you how to deploy them using real world examples. So let's first take a look at what our expectations are for Q3 earnings. And in order to do that, let's first take a look back as far as how the second quarter earnings performed. So first of all, from a broad-based market expectation and what we actually saw from Q2, granted, we came out from what we would consider fairly unprecedented times. This was really the first, Q2 was really the first quarter that encompassed all of the coronavirus, if you will, because Q1 only had about a few weeks, if you will, of the coronavirus. Q2 was the full boat. And the reality is that markets were expecting some pretty sizable declines in both sales and earnings per share. The market was expecting about a 53% decline year over year for earnings and about 11% decline in terms of revenue. But what we actually saw was a substantial deviation from what the market was expecting. Only about a 32% decline in earnings per share versus an 8.4% decline in terms of sales. So a fairly sizable beat on both the top line and the bottom line. From my perspective, the net positive that I really see is that net sales was only down about 8%, substantially lower than I think what most investors were concerned about at the beginning of the coronavirus. Certainly earnings has certainly declined substantially, but we expect earnings to recover fairly quickly if the revenue is there. The revenue for the most part is still there, so this is overall a net positive. 9 out of the 11 sectors actually ended up beating the consensus for the S&P 500. Now, the one thing that did stand out from our perspective is that Q2 was driven a lot by a few big names that really lifted the earnings per share growth within the S&P 500. Amazon and Apple, the two stocks alone, accounted for 15% of the earnings beat. 15% of this increase above the 53% consensus came from just Apple and Amazon alone. So a lot of concentration from these two particular names. And the one thing that I think is really important, the one metric that I think is very important to pay attention to, is really not just the size of the beat, because sometimes the market's already expecting the beat, so that's already priced in. What we really want to take a look at is how do markets respond to beats and misses. And what we saw here is, in most quarters when you look at it, there tends to be a skew from either the market providing gains for stocks that beat by a substantial margin, or large losses for stocks that miss. And what we saw on Q2 was that stocks that missed their earnings and revenue targets were hit substantially more, about 1.8% lower the next day for stocks that missed their earnings versus stocks that beat only gained less than half of that, 0.7%. So we're seeing a skew in terms of markets reacting more negatively to misses than they do to beats. Now, that is important because when you're looking for options or when you're looking for opportunities, you want to know, do I have a better opportunity to make money on stocks that I think are going to beat, or do I have a better opportunity to make money if I think the stock is going to miss? And Q2 certainly pointed us in the direction of misses, had larger moves than gain stocks that beat. Now, my expectation for Q3 is actually going to be something similar to this. Perhaps not at the same extreme level, but certainly stocks that miss will likely have significantly larger moves to the downside than stocks that beat are going to necessarily see substantial moves to the upside. And I think in the early preview, what we saw so far, when you have Bank of America, when you have JP Morgan, Goldman Sachs, all of these names, some of the big beats from Morgan Stanley, from Goldman Sachs, from JP Morgan, did not see big moves to the upside. But we did see, so far, we haven't seen any huge losses, at least from, or big misses from some of the big names. But we have seen some big moves to the downside. So very early in the season, but I'm expecting the same trend to last going into Q3. So what are our expectations for Q3? Number one, our expectation now is still going to be a further decline versus the same time last year. Before consensus was about a 53% decline for Q2. For Q3, now our expectation is about 22% decline in earnings per share versus Q3 of last year. So substantially less negative view here from last quarter, which is what we expect. And if we look at the broader macro picture for Q2, certainly points us to what is likely going to be a very sizable beat here to the upside. So the market is expecting about a 22% decline in earnings per share for Q3 versus last year. I think we're going to come in substantially better than that. And one of the things that is really useful in helping predict potential gains to the upside is really the guidance ratio, or the amount of positive versus negative guidance that we see from companies. So when a company provides positive guidance, meaning they provide guidance that is higher than what they were originally providing, that's what we consider positive guidance. So if a company previously expected to make $1 billion in 2020, now says that they think they're going to make 1.1 billion, that's a positive guidance. Subsequently, if that same company that originally guided at $1 billion is now saying they're going to come in at 900 million versus $1 billion, that's what we consider negative guidance. So normally the ratio between these two are pretty close to 1, but right now we're seeing a positive to negative guidance of about 3.3 to 1. So substantially more positive guidance rather than negative guidance. And that is one of the strongest ratios on record ever. So management fairly optimistic, if you will, of the recovery that we're currently seeing in Q3. And we expect that to reflect in the earnings that we're going to see in Q3. When we look at the sectors themselves and we look at the stocks that have provided the most upward revision, so this revision that I'm referring to in terms of guidance that management provides, what we're seeing is that consumer staples, healthcare, and materials are really the sectors that have provided the most upward revisions. This is both between analysts as well as company guidance. And then if we look at companies or analysts that have revised their estimates lower, we see more downward revisions within energy and utilities. So those are the sectors that we expect will likely underperform. So when we're looking for outperformance, we generally try to focus on some of the stronger sectors. And consumer staples, healthcare, and materials, not the strongest sectors, but certainly one of the stronger sectors. And usually that's actually good for us to see upward revision on some of the sectors that are strong, but not the strongest sectors. On the downside, energy and utilities remain two of the weakest sectors. Utilities have come back to life a little bit over the past couple of weeks or so, but for the most part, utilities, a large underperforming of the broader markets. Energy still the weakest performer in the broader S&P 500. So from an opportunities and sectors perspective, that's how we're currently viewing the landscape. So now let's turn our attention to trading earnings. So first of all, what are earnings? This is for those of you that are relatively new to investing or trading options around earnings. Earnings is really the time 4 times a year where companies report their quarterly revenues, their profits, and provide sometimes some forward guidance as to what they expect for the rest of the year. Now, during the coronavirus, many companies pulled back their forward guidance simply because they didn't have visibility themselves into what the shape of the recovery was going to be and what revenues they were going to expect. We do expect with Q3 earnings for there to be more forward guidance, and many times it's actually this forward guidance that drives a lot of the outperformance or underperformance of a stock going into earnings or after earnings rather, that the revenue and profits themselves generally have less impact on the forward movement of the underlying stock than the forward guidance that's actually provided. So keep a close eye on forward guidance rather than the revenues and profits themselves. Now, why should we pay attention to this, or what does this all mean? It really comes down to the fact that when new information is released from a company, that information is immediately absorbed into the markets. And that creates what we call a binary event, where the markets effectively instantly reprice the stock based on that new information. And this produces what we call some extreme volatility that can be useful as opportunities. Now, these opportunities obviously are a bit of a double-edged sword from the perspective of if you get the directional view correct and you get a quick move in a very fast market, you can potentially make a lot of money very quickly. But on the flip side, if you're on the wrong side of that directional view, you could lose money very quickly, which is why we turn to options when we talk about trying to trade these earnings announcements, because options allow us to leverage our capital, but do so in a way with limited risk. So if you're buying a call option, you're able to take a bullish view on a stock, but do so in a way so that if the stock doesn't go higher and instead goes substantially lower, that you have a limited amount of capital or a limited amount of losses to the downside. And I just have to, point out that there's Fastly on the news last night that TikTok is not using their services as much as they expected to, decline about 25% after market hours. Now that's an extreme case, but that is an example of a stock that the market was very bullish on, one of the strongest performing stocks in the market, but based on negative guidance that they were providing in terms of what they were expecting going forward for the rest of the year, the stock declined 25% overnight. If you had went long Fastly using the stock itself, you would have lost 25% of your investment in a single few minutes. If you had used a call option, you might have only risked maybe 10 or 15% of the underlying stock. So this is really comes down to how can you leverage your capital so that if you're right, you make money, but if you're wrong, there's a limited amount of capital that you can risk. So call options are typically useful for strong stocks that you think are going to beat on earnings. Put options are useful on weak stocks that you think are going to miss on earnings. Now we're going to talk a little bit about the different strategies as to how to go about profit utilizing options. So what I'm going to do is I'm going to break down the different option strategies that you can trade using earnings into two possible categories. You can either buy options or you can be selling options. So we're going to talk about buying options first. And both strategies have its pros and cons. So I want to talk a little bit about what those pros and cons are before you start trading or before you decide which strategy perhaps is suitable for you. So whenever we talk about buying options, the benefit of buying options, it really comes down to the fact that you have limited risk. Whenever you buy a call option, a put option, or a debit spread, the amount of capital that you have at risk is truly limited. And you have leverage on your capital, but no matter what happens, there's only a set amount that you can risk. Now, with this type of risk to reward ratio where the risk is limited and the upside many times can be leveraged multiple times to the capital that you're committing to the trade, the downside to it is what I call one step forward, two steps back whenever you're trading earnings, because whenever we're trading earnings, there's generally three factors that are most at play when we're trading earnings. And when you're buying an option, what you have are two out of the three factors constantly working against you. And what you have is one additional factor that, if works in your favor, can overcome the other two, but you really have two things working against you while you have one thing that can potentially work in your favor. So let's first talk about the two things that are working against you. Number one, time decay. Time decay is one that is always going to work against us whenever we're buying options. It doesn't matter whether we're trading earnings or not. Time decay is always a factor. Whenever we buy a call or a put, the value of that call or put is going to erode every single day that we hold on to it. So that's the first thing that's working against us. The second additional thing that's working against us when we're buying a call or a put going into earnings is the fact of this concept called the volatility crush. And volatility crush refers to the fact that before an earnings announcement, the value of a call or a put option will naturally be elevated in price. And the reason for this is because there's a lot of uncertainty between now and the expiration date for a call option if there's an earnings announcement coming out. So a call or put sellers, someone who's selling that call or put, is going to demand a higher premium for selling that call or put option because they're taking on the opposite side of the risk. They're taking on unlimited risk in exchange for a fixed potential upfront income. So as a call buyer, you need to pay that elevated premium. Now, once the announcement is out, once the news is out, that uncertainty is gone, and that elevated premium that market makers will charge or call or put sellers will charge will naturally decrease. So what you have is the value of a call or put, with all things equal, even if the stock price doesn't move, what you have is the call or put option will actually decrease in value a little bit. And this is what we refer to as volatility crush, because the implied volatility of an option will decline after the earnings announcement because the uncertainty is no longer there. We have new information, and that reduces the volatility of that stock going forward. So you have these two factors working against you. And on the other side, you have the directional view. So we typically refer to time decay as theta. We refer to volatility crush as vega, our exposure to implied volatility. And lastly, what we have is delta, our exposure to the underlying stock. So if the stock makes a big move, to the upside on a beat, or if it makes a big move to the downside on a miss, that has a factor on delta. Delta is the biggest risk that we're actually taking. So if we get the directional view correct, then what we're trying to do is have delta, the large stock move, offset the volatility crush and the time decay that we have, that we know that we experience. And if the large stock move is large enough to overcome the volatility crush and the time decay, then we'll make money on the trade. But it's important to understand that it's possible that sometimes you might find yourself in a position where you actually have a a stock move. The stock moves in the direction that you expect it to, but it doesn't move far enough that it moves just a little bit, in the direction that you expect it to. So the stock maybe beats on earnings, but only moves up 0.5% or 1%, meaning you get a move, but it's not large enough to overcome the volatility crush and time decay. And this is probably the hardest part about trading options or buying options going into an earnings announcement, because you have these two things working against you right off the bat. So that you need to have the stock move a substantial amount in the direction that you expect it to offset the volatility crush and time decay just to break even. So you really need a big move in the underlying stock in order for you to be potentially profitable. Obviously, if the stock goes against you, then you really have three factors working against you, and you can expect, a large amount of the capital that you commit to a trade to be a potential loser here. So that's the challenge whenever you're buying a call or a put going into an earnings announcement, is the fact that you have these two factors working against you that may be difficult for you to overcome. Now, I want to make sure everyone understands this before we move on. So please type 1 into the chat window if this concept makes sense to you. And we're going to go through some real numbers to help solidify this. But it's first important to understand the concept before we start looking at some numbers. Okay, so I see a lot of ones. So now let's talk a little bit about, okay, what if we don't buy an option? What if we sell an option going into an earnings announcement? And this is really where we reverse it. We have two things now working in our favor and one thing that can potentially work against us. So before, when we buy an option, volatility crush and time decay work against us. When we're selling options, it's the exact opposite. Volatility crush and time decay work in our favor. Now, many investors will say, great, I'll take the strategy that has two things working in my favor rather than two things working against me. But the flip side to that is the fact that when you have a large move to the downside, this strategy, whenever you're selling options, has technically unlimited risk. So now what happens is, yes, as a seller of a call or a put going into earnings, you're going to receive higher premiums because implied volatility is higher. You have time decay working in your favor. But if the trade goes in your favor, then you have all three things working against you. And that's a beautiful, I would say, outcome. But if the trade goes against you, there's no limit as to how much money you can lose on that large stock move. But the amount of money that you can make from volatility crush and time decay, it's fixed. There's a certain amount that you can make here no matter what happens. Even if the trade goes in your favor, you can only make a certain amount of volatility and time decay. But there's no limit as to how much money you can lose if the trade goes against you. So that's the inverse risk reward that you're taking here, is that you have two things working in your favor, but you have one thing that could potentially put a massive step back in your strategy, which is when you're selling an option, you have unlimited risk. That unlimited risk factor, if the trade goes against you, can easily overcome the volatility crush and the time decay. But if the trade goes in your favor, then you really have three things working in your favor. And this is part of why I think some investors prefer selling options going into earnings. And what we're going to talk about is, how can you sell options going into earnings but not take on unlimited risk using strategies like a credit spread or any type of limited risk selling strategies? But before I move on, does that make sense, everyone? Please type 2 into the chat window. How, when you're selling an option, the different factors, generally speaking, work in your favor, but you have that one thing that could potentially blow up the trade when the trade goes in the wrong directional view that you originally expected. So that's the risk that you're taking when you take on this, what some investors might consider a more attractive risk strategy from an option strategy perspective. Okay, perfect. So we talked about the large stock move, we talked about volatility crush, and we talked about time decay. Now let's talk a little bit about how to define them, how to quantify it, right? Because so far we've talked about it from a conceptual perspective. So like I said, we have three things at play. We have delta, we have vega, and we have theta. Delta is the change of the options of the price of the option with respect to the change in the stock price. So if the stock price goes higher or lower. Vega is the change in the option price with respect to changes in volatility. So as implied volatility declines, or what we call the volatility crush after earnings, how does the value of the option decay or reduce by the change in implied volatility? And lastly, theta, how does the value of the option decay with respect to the passing of time? So these three Greeks are really important for trading earnings because they help us define the three factors that affect the value of our option going into and after the earnings event. So whenever we talk about an option that has a delta of 0.5, that means if the stock moves up or down by $1, the value of your option will move by 50 cents, half as much. That's the delta of 0.5, tells us the sensitivity of the option to the sensitivity of the to the movements of the underlying stock. If you see a vega of 0.25, that means for every 1% change in the implied volatility of an option, that will increase or decrease the value of that option by 25 cents, a quarter of the sensitivity. And lastly, if you have a theta of 0.1, that refers to for every day that passes, your option will lose roughly 10 cents a day. So the Greeks help us quantify the changes that we can expect from our option strategies going into the earnings announcement. And I don't expect you to remember this, right? Or I don't expect you to know how to do the math behind this. This is really what the OptionsPlay tool is designed to do. It does the math for you. You don't even have to know the Greeks in order to do it. Our P&L simulator will actually do the math for you. But it's important that you understand conceptually what moves the value of your option around earnings, and generally speaking, which Greeks are relative or are important for you to understand if you're going to trade options around an earnings announcement. So let's talk a little bit about the actual strategies that you would deploy. So before we were talking about buying versus selling options, and we were talking about buying calls and puts and selling calls or puts. But you can do more in your option strategy. You don't have to just buy calls and puts. Now, like I said before, when you buy a call or a put going into an earnings announcement, the biggest, I would say, deficit to that strategy is the fact that you have two things working against you: volatility crush and time decay. And what you need is the underlying stock to make a big enough move to offset the losses that you have from volatility and time to crush, so that the two end up adding up to a positive number. You want to make sure that what you lose to volatility and crush, a volatility crush and time decay, is less than what you make on the movement of the underlying stock. And if that's a positive number, then you're profitable. If that number is negative, then you're going to be taking a loss on that trade. So whenever we're talking about buying a call or a put, this has to only be, this is a strategy that is reserved for stocks that you think are going to make a big move. Think about stocks like technology stocks, think about biotech stocks, think about stocks that you know have the highest probability of making a big move. Those are the ones that you generally want to reserve for buying a call or a put. And you only want to do this on stocks that you think can make a big move, because you truly have unlimited profit potential on these types of trades. But you are putting a fairly large amount of capital at risk on these types of trades. So with that, one of the things that you can do as an options investor is that you don't always just come across stocks that you think are going to make a big move. Sometimes you think the stock's going to make an average move, or perhaps a sizable move, but you don't think it's going to make a 25% jump on earnings. Maybe you're talking about a blue chip stock like IBM or Procter & Gamble, and you just know that these types of stocks don't move big numbers on earnings. So one of the things that you can do when you expect more of a modest or slower move, but you still want to be buying options, is the fact that you can trade a debit vertical spread. A debit vertical spread is very similar to a long call or a put, but it reduces the cost of the trade, it reduces the amount of risk, it reduces the amount of capital that is required to enter the trade, and the trade doesn't have to move as far in order for it to be profitable. So you have a higher probability of profit. Now, this type of strategy, the benefits that you get are lower risk, the fact that you have a higher probability of profit, but what you're trading off for that is the fact that you have now limited profit potential. Before, you had unlimited profit potential. Now you have limited profit potential. But again, you have a smaller amount of capital at risk. And sometimes when you expect a stock, a blue chip stock, a big name stock, and you think that it's not going to make a big move, a debit vertical spread is perhaps best suited for that. Lastly, you can also take advantage of this implied volatility crush by using what we call a time spread. So a calendar or diagonal spread, where the option that you're selling is a shorter dated option than the option that you're buying. Because shorter dated options will typically have more implied volatility crush than that longer dated option. So you want to buy the option that has less implied volatility crush, and you want to sell the option that has higher implied volatility crush. So that kind of negates a little bit of that implied volatility crush factor that you have, or that's working against you when you're buying an option. The debit spread does the same thing, but the time spread, the calendars and diagonals, take that to even a slightly more extreme example, where the short option has higher theta and lower volatility crush, and that's going to help negate the two factors that are really working against you when you're buying an option. This also has limited profit potential and generally puts a smaller amount of capital at risk. But both of these are for when you expect more of a modest or slower move. They are very similar to each other. There's slight variations on the same trade, just that one on the vertical spread, you're trading the same expiration date. On the calendar spread, you're trading separate expiration dates, but you're always buying an option and selling an option against it to offset some of that volatility crush and time decay. Now, I get a lot of questions about when you're trading these, how far out do you typically want to enter this trade, and when do you generally want to exit this trade? So first of all, whenever we're trading, whenever we're speculating on an earnings event, generally speaking, you don't want to enter it too far in advance of the announcement. And the reason for that is because of time decay. If you're buying an option 3 weeks before earnings, then you're going to suffer 3 weeks of time decay before the earnings event is actually taking place. Maybe you think the stock's going to make a run going into earnings, and if that's the case, that's okay. But if you're playing purely based on earnings, you generally want to wait right before earnings to get into that trade. Usually 1 to 3 days before earnings is a good starting point. And then if you're truly just trying to capture the earnings announcement, you generally want to be out no more than 3 to 5 days past the earnings announcement, unless you have longer term views, or your views on the stock has changed because of the new information that you now have from the underlying stock. If that is the case, you can certainly hold on to it, but generally speaking, you want to get out of it about 3 to 5 days after earnings. Now, we do have, we can talk a little bit about neutral strategies. So for stocks that you think are not going to make a big move, this is really where we can turn to more selling option strategies. Because again, selling option strategies are suitable when you don't expect a big move in the underlying stock, because that's the one thing that could really blow up that strategy. So the strategy that we typically look at are selling credit spreads. This allows you to sell an earnings play, but do so in a way with limited risk, because the key here is having limited profit potential, but more importantly, puts you at an advantage from the perspective that if the trade doesn't work out, that you have limited amounts of risk. Now, there are downsides or trade-offs, if you will, for the strategy, because whenever you're selling an option strategy, you're going to be putting a fairly substantial amount of capital at risk, certainly more capital than the income that you are receiving on that trade. So even if the trade works out perfectly, the amount of capital that you can capture from that is always going to be less than what you're going to be putting up as risk, or your max risk on the trade. So that's I would say, the trade-off that you're making with these neutral strategies, where you have volatility crush and time decay working in your favor. It's the fact that you're going to take on more risk than what you can potentially make. But same thing, you generally want to exit about 1 to 3 days before earnings, and you generally want to be out about 3 to 5 days after earnings. Unless the trade, you're trying to capture more of that time decay, you can hold on to it for a little longer. But again, generally speaking, we tend to find that you will tend to exit these relatively quickly, especially after the stock makes a move in the direction that you might expect it to. So with that, what I want to do is I want to take a look at the earnings calendar. This is something that we publish every single day here at OptionsPlay. I'm going to show you how to access it using your OptionsPlay platform. But this is the earnings calendar that we produced that gives you a sense for, out of all the hundreds of stocks that could be reporting on a single day, which ones have the most liquidity from an options perspective, which ones are somewhat liquid, and which ones are ones that you generally want to avoid trading earnings on. And it's color coded for you, so it's easy for you to quickly sort and filter which ones you want to pay attention to. You have the dates up on top, so on each given date, you see all the stocks that are reporting on that specific date, and you have it color coded. The ones in green are the ones that are most liquid, like Amazon, Intel, Coca-Cola, AT&T. The ones in yellow are the somewhat liquid. So if you look at American Airlines, American Eagle, COF, which I believe is Capital One, Dow Chemical, Freeport, Macaron. These are stocks that are somewhat liquid. So if you're trading options, you know that you're going to have a little bit more trouble getting in and out at the midpoint, but generally speaking, you're still going to be able to execute trades. And then everything below that that's in white are the strategies that are not liquid at all. Those are the ones that you generally want to avoid. You don't want to trade the ones that aren't very liquid, because you're going to have a lot more trouble buying and selling those options and being able to get in and out of those trades. So whenever you're thinking about trading options, make sure you use our earnings calendar. I'm going to show you again. On the OptionsPlay tool, you can access the earnings calendar by clicking on this button here at the bottom of your screen. No matter where you are in OptionsPlay, at the bottom of your screen, you have a link called earnings. When you click on that earnings link, it's going to take you to our earnings calendar. Again, our earnings calendar is fairly straightforward. It's really easy to read. It's by dates across the board. Green are the most liquid, yellow are somewhat liquid, and anything outside of that, not liquid at all. So focus on the green ones. If you can't find anything, the green ones, then go out to the yellow ones. If you can't find anything, the yellow ones, generally move away from that trading on that specific day. But this is really designed from the ground up to try to make your life as easy as possible for trading options and finding opportunities in your option strategies. So with that, what I'll do is I'll go through a couple of examples. I'll go through a couple of examples just to show you how you could potentially look at a play using OptionsPlay and understand a little bit about how volatility crush, how implied volatility, and all of these things factor into your play. So let's take a look at a stock like Procter & Gamble. It reports here on Tuesday, the 20th. So let's take a look at Procter & Gamble. Now, Procter & Gamble is by far the strongest and also the largest stock in the XLP, the staples sector. Procter & Gamble is almost 10% of XLP. And if you look at all the stocks within XLP, Procter & Gamble is one of the strongest of those stocks, recently breaking out to new all-time highs above that 141. So you have a strong stock relative to not only the market, but to the sector itself. These are usually the type of clues that you see of a stock that is likely going to beat on earnings. But Procter & Gamble is also a pretty boring stock. It's not the type of stock that rallies 15% on earnings, generally speaking. You see Procter & Gamble usually move 2-3%. So because of that, I usually would prefer more on the neutral strategy, selling option premium. So what I'm going to do is I'm going to take a look at selling some option premium going into the earnings announcement here. Let's say I choose something like a 143, 136 put spread here, selling a credit spread versus buying a call versus buying a call spread. And what I'm going to use is the P&L simulator to simulate how this strategy or how this earnings play might work out here. So Procter & Gamble reports earnings here on October 20th. So let's say that I think that Procter & Gamble, which is currently trading at 143, could be marginally higher. Let's say 146, 147 on earnings a few days after earnings. Let's say on October, let's say 20, let's call it a week after earnings on the 27th. Now, like I said, what we know is that you have the stock potentially working in your favor. That's delta. We know there's going to be time decay. That's why we have this time slider, so that we can roughly estimate how much premium you would either lose or gain due to time decay. And the last piece is volatility, timed volatility crush. And we know that volatility will come down after earnings. Now, this is not an exact, it's hard to predict exactly how much volatility is going to come down, but that's why I usually start with the at the money volatilities, and I usually adjust it close to halfway down, down the slider. because the bottom of the slider is the low end of the range for implied volatility. And what we're doing is we're saying we're going to go halfway towards the lower end of the range. Now, again, this is just an estimate. It is not by any means an exact science, but it's a good starting point to give us an understanding as to how these strategies will perform. So as you can see, if I sold this credit spread, and the stock moved up marginally higher, just a few bucks higher, right? Procter & Gamble's not a big mover. So let's say it beats on earnings, moves to a couple of percentage, maybe 1 or 2 percentage points higher. And a week after earnings, we know volatility is going to come down a little. Right now, Procter & Gamble's trading at about 19 vol. Let's say it trades down to about 15% vol. What does my P&L look like? As you can see here, if I sold the credit spread, I'm looking at about a 60% return on my capital. I'm risking $444 to potentially make 256. I'll make 155 out of that maximum 256 if the stock trades marginally higher a week after earnings and volatility comes down. If I bought a call option here, notice how I'm looking at about a $41 profit on a $450 risk. So as you can see, the two trades, very similar risk, right? So that one is risking 444, one is risking 450. So between the two strategies, if I'm looking at selling a put credit spread or buying a call option, I think I'll certainly lean towards selling that put premium because I'm going to collect $155 in profits versus just $41 in profits. And lastly, let's take a look at the vertical spread here, the call spread here, risking 409. So slightly less than out of the three strategies, but as you can see across the board, the three strategies risking roughly the same. And if the trade goes in my favor here, I make marginally a little bit more money, $45 versus just $41. But both strategies, because whenever you're buying an option, you have time decay and volatility crush working against you. If the stock doesn't move enough, you're not going to be able to overcome that volatility crush and time decay. And that's what we see on the two strategies on the right-hand side. Now, how do you make money with the two strategies on the right-hand side? You really need the stock to make a sizable move to the upside. As you can see, if the stock gets up to 149 or so, now these two strategies starts to come to life at about 149. So you have to ask yourself, do I think Procter & Gamble is going to get up to 149? If this is the type of stock that you think can make a big move, well, certainly that call or call spread can really pay off, because if Procter & Gamble really takes off, so if it goes up to 153 or 155, and I will say, we've seen some pretty spectacular moves to the upside from the previous, I would say, 3 or 4 earnings seasons. So it's not completely out of the realm for a name like Procter & Gamble maybe consolidating a lot within the consumer staple space, taking away market share from some of the other stocks, and really taking off from that perspective. It is possible, right? But if it, as you can see here, if that happens, notice how much higher the performance is on that call option versus selling that put premium. So when you're selling that premium, you're fixed in terms of how much money you can make. When you're buying that call option, there's no limit as to how much money you can make. So it really comes down to, do you expect a big move to happen on the underlying stock or not? Okay, so this is how you can use the OptionsPlay tool to compare buying option strategies versus selling option strategies, see which strategy performs best. So as you can see, if Procter & Gamble doesn't move at all and just stays where it is, and you sold that put spread, you would at least have a small profit to show for it. If you bought the call or the call spread, you would lose about a third of the investment that you had made in those call or call vertical spreads. So that gives you a quick preview as to what your potential gains are, what your potential risks are. And also at the flip side, understand, well, in a worst case scenario, if Procter & Gamble declines back down to 135, how much do I have at risk? Right here, you're risking 284, you're risking 422, here you're risking 381. So also not only understanding what your potential rewards are, it's also really important to understand if this trade doesn't go in the direction you expect it to, have an understanding as to what your expected losses should be, because you need to make sure you're comfortable with those numbers before you execute one of these trades. So this is just a quick example of how you can utilize OptionsPlay to search for some opportunities. And I'll just do one more just to show you again, give you an idea as far as how you could use this. Let's take a look at maybe American Airlines. The airlines have really not been doing particularly well. Maybe you think American Airlines will continue to struggle. So maybe you're going to look at some either buying some put options or perhaps selling a call credit spread, selling some premium here. However you like to structure this, maybe you sell something like 12.5, 14.5 credit spread here. So we compare buying a put to buying a put spread to selling a call. Notice how all three strategies have very similar max risks. So let's take a look at these trades and compare them side by side. So American Airlines reports earnings on October 22nd. So let's say a week after earnings, October 22nd, that's a Sunday. I'm gonna have to look into that. No, October 22nd is a Thursday. I'm looking at November, that explains it. So October 29th, a week after earnings, let's say American Airlines, which is trading at about 12 bucks right now, maybe misses earnings and trades back down to the lower end of the range, maybe $11.50. $11.50. Now, American Airlines trading at a very, very volatile 81% implied volatility. That is a lot of implied volatility. So let's say that comes down back into the, let's say, the 60s or so. Again, this is just a rough estimate as to what you can expect. But as you can see here, if American Airlines declines about $11.50, which is close to, it's about 8% decline on the underlying stock. That's not a small move, right? Notice how here, if the stock declines about 8% a week after earnings, if I sold the call credit spread, I'm looking at about a 47% return, meaning out of the $65 that I could potentially make on this trade, I'm making about half of that, about $30 out of the possible 65. If I bought a put option, I would be risking $160 to potentially make up to $1,000 if the stock goes to zero. But as you can see here, even if the stock declines 8%, the volatility crush and the time decay is still going to be greater than what I make back on the fact that the stock declines 8%. That's how difficult sometimes it is to buy an option going into earnings. So here, the put option here for American Airlines, very, very expensive. $1.60 on a $12 stock. That's paying more than 10% of the underlying stock's value to take a bearish bet going out just about 45 days. That's a lot to be paying. Versus this put spread certainly reduces it quite a bit, down from $160 to $128. So you're going from about close to 14% of the underlying stock price to about 10% of the underlying stock price. But still, even when you're paying that much, you're going to lose a lot to time premium. You're going to lose a lot to a volatility crush. And what that means is that even if the trade makes an 8% decline, so imagine getting the direction right? You called the stock moving lower correctly. The stock moves 8% lower. And guess what? You make a paltry $10 on the $128 that you've risked, which is about a 9% return, a little over 8% return. So this is really where the challenge of buying an option going into earnings is hopefully a little bit more apparent using the P&L simulator. But you can also use the simulator to see, well, how far does the stock need to move down before this gets really interesting? So now we're looking at about when the stock at about $11, now you're looking at a trade where the put or the put spread is really starting to shine at about $11. Now, American Airlines is very volatile. It's very possible that maybe the stock declines to $9 or $8. The one standard deviation here is about $9, a little over $9 or so. So maybe $9.50 or so. And here, as you can see, when I've sold the credit spread, I can only make about $60 in terms of potential profits out of my $140 that I'm risking. Versus here, I'm making $133 or $146 on roughly the same amount of risk, more than double what I could potentially make. So again, it all comes down to, do I expect the stock to make a big move? If I do, I can look at buying a put or a put spread, but understand that the big challenge is the fact that even if you get the directional view correct, if the move isn't large enough, you may not overcome what you lose to volatility, crush, and time decay. So be very careful. And if the trade goes against you, make sure you understand what you have at risk in terms of if the trade goes against you. Very, very important going into earnings. So with that, that covers what I wanted to share with you here today. I hope that this was useful in giving you a better understanding as to how options premiums are affected around earnings, how you can use OptionsPlay to model them out and have a better understanding as to how they would perform around earnings, and most importantly, how to access the earnings calendar so that you know which symbols are most liquid and which ones you want to pay attention to going into an earnings announcement each individual week. So you know what's coming up, which ones are liquid, so that you can focus your research on these names, because these are the ones that you're going to be able to trade options on. If you focus your research on these, guess what? You might not be able to find an options trade to make off of that. So with that, I just want to thank our members for supporting us and allowing us to continue doing this, because you guys support us, and we're gonna be doing more members only content tomorrow morning. I'm going to be doing a full technical analysis guide in terms of back testing technical indicators. A lot of you use technical indicators in your trading. So we're going to be utilizing our massive back test that we just ran and show you which technical indicators have the best performance, what surprising observations we made from certain indicators, where there was best performance, where there was worst performance, and also from a risk management perspective, how many consecutive losses or how many consecutive false signals can you expect from certain technical indicators? Those are some of the really surprising things that we found out. So I hope that for those of you that are members, will be able to join us tomorrow morning at 8:30 a.m. If you don't have a membership just yet and you want to join us, you can still become a member by going to trade.optionsplay.com/member, which I will send to you on the chat window. And if you don't have an OptionsPlay account just yet, if you're a first-time viewer, you can sign up for a free 30-day trial at optionsplay.com, and you will also get an invite to that session tomorrow morning. So I'm really looking forward to doing that, because technical analysis is near to dear in my heart. I've been using it for about 15 years in my career. It's what I've dedicated a lot of my time in making sure that everyone understands how to use it properly. So I'm really excited to share with you some of the data behind just how effective technical analysis could be for your portfolio, but also how can you leverage it properly for your portfolio. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, there's both a chat window and a Q&A window. Please type your question into the Q&A window, and I will answer your questions out of there. So if you have a question regarding the session that we talked about here today, please type your questions into the Q&A window, and I will answer your questions out of there. For any of these strategies, to use the same deltas as you had explained or taught before. Yes, we would use the same deltas that we would use for any of the debit and credit spread webinars that we've already taught. I'm registered a member. What I have, so if you just have a free access to OptionsPlay through the Montreal Exchange, that would not give you access to the members only session tomorrow morning. You need to have a membership to the US version of OptionsPlay. We are only covering US markets tomorrow morning. So when we talk about the back test that we've done for technical analysis, we did it only on US markets, just to be clear. And yes, we are going to start tomorrow morning a little earlier at 8:30 a.m. because we did the members only session last week and we ran into the trading session. We want to make sure that we don't go into the beginning of the trading session, because I know many of you like to trade around the open. So we're starting a little earlier so that we can cover everything we need, answer your questions, and still have you done before the market opens tomorrow morning. Okay, sorry, there's a lot of questions. I'm just trying to scroll through to get to the questions here. When selling a put credit spread, what should be the typical risk to reward ratio that I should be looking for? So Michelle, we generally try to have at least no more than 2 to 1. So the amount of reward is no greater than 2 times the risk. If for those of you that follow our credit spread report, we generally try to skew that even further to about 1.5 to 1. So the risk reward ratio is at worst 2 to 1, at best closer to 1.5 to 1 on a put credit spread. When a put costs a high percentage of the underlying stock price, such as with American Airlines, does that mean the market expects that to be the direction or outcome? No. So just to be clear, volatility and direction are two separate things. And a lot of people sometimes get a little confused between the two. But volatility speaks to the, the amount of uncertainty, meaning there's a lot of uncertainty around where American Airlines is going to come out. So we expect there's going to be a sizable move. Which direction that sizable move, the volatility does not give us any indication on that for. So volatility only tells us the amount of uncertainty. It does not tell us direction. Ronald, thank you so much. Rahim is saying, on the American Airlines trade, the vertical with $65 cost, does that mean you have to close it out or you can let it expire for profit? On the American Airlines call vertical, the spread, so on the American Airlines trade, there was a credit of 65 cents. That's why the trade cost is negative 65. So you're collecting 65 cents to sell that credit spread. Does that mean you have to close it out or can you let it expire for a profit? You can do either one, but we generally don't let credit spreads expire. We usually close it out prior to expiration. For curiosity, only have looked at Earnings Whisperer. Any thoughts? So Ron, I'm not familiar with the Earnings Whisperer, so unfortunately I can't really comment. Do you have a replay of previous sessions where more basic material is covered? Absolutely. Tomorrow we have every single webinar that we do, including our beginners options courses, are recorded. So you can find that recording. I'm going to send you a link to our OptionsPlay YouTube channel. I'll post the link into the chat window for those of you that want to follow us here on YouTube. All of our beginners, so as you can see, we have this beginner options master course. You can use this as a starting point for your learning experience. So you can use this to, we have it on the US site, where we have a beginner's options trading course. You can use this. This is all the beginner topics. So if you're looking for that, find the most recent videos, and I would start there if you're looking to learn how to trade options. Are you going to send an invite for this webinar? Manuel, if you're referring to the members only webinar, that is available to members. We will send an email to everyone for you to register. Yep, if you're a member, then you will receive that email. Ed, you said something about with Procter & Gamble, but I don't know what you mean, if you can clarify. Sung Lee is saying, what if you're selling a put or call spread for credit? Would 3 work better on the earnings calendar? No, not at all, because whenever you're selling a credit spread, you're still going to have to need the liquidity to get in and out of that credit spread. So anything in a 3 is going to be worse off for any option strategy. It doesn't matter if you're buying or selling. Do butterflies during earnings work well? So butterflies are strategies. Butterflies can work well. So if you think a stock's going to make a very neutral view, butterflies really take advantage of that volatility crush and time decay because you're short both the call and the put. So you have potentially maximum volatility crush, maximum theta. But if the stock doesn't end up at the apex of your triangle or of your butterfly, then you've got the directional view wrong. So it's difficult, I would say, because you really have 2 things working in your favor and then 1 massive thing working against you. How do I screen for maximum potential volatility crush? Well, one of the ways that you can do that is using our liquidity list. So if you look at the liquidity list, when you click on it, we have a thing called IV rank. The ones with the highest IV ranks are going to be the ones that have the highest probability of a higher volatility crush. So as you can see here, you have Amazon, which is at a 67% IV rank and it reports earnings in 7 days. That would be a stock that I think has a high probability of the largest IV crush. If we look at other ones, so TSM, this reported actually this morning, so this is no longer valid. I'm just trying to find here. Netflix, 47% implied volatility rank. It reports earnings in 5 days. That's possibly a good one here. Twilio, 46% rank. Certainly one that I would pay attention to. XLNX, a semiconductor stock, reports earnings on the 6th. And one thing that we did add here is AM and PM so that you can see whether it reports earnings in the morning or in the afternoon. A lot of questions regarding that. So we wanted to add that to you on your earnings date. And you will also see that here. We're going to be adding that to the earnings date here where you have an AM and PM next week. So going into earnings season, you'll know whether the stock reports earnings in the morning or in the afternoon. This was great, Jeff. Thank you. Can you talk about the pros and cons of using long versus short expirations in trading earnings season? So, Jeff, that has nothing to do with earnings, but generally speaking, whenever you're selling, you want to lean towards shorter dated expirations. Whenever you're buying, you want to lean towards longer dated expirations. And that's the concept of trading calendars and diagonals, is you're selling the short dated option and you're buying a long dated option because you want to have the most volatility crushing time decay on that short option, and you want to have the least amount of volatility crushing time decay on that long option. That's why calendar spreads are very popular around earnings. When you expect a big move but don't know which way, like Zoom or Peloton, is a straddle and strangle in order? So Jacob, in theory, yes, but all the challenges that we just talked about, having volatility crush and time decay, when you trade a straddle or strangle, you have double the volatility crush and double the time decay. And you only have one side of the trade that's going to work in your favor. So you actually have effectively what are 4 things working against you and only one thing that can potentially work in your favor. So I'm sorry, 5 things that are working against you and only one thing working in your favor. So you really need such a large move on the underlying stock where it almost never makes sense to buy that straddle and strangle. Conceptually, you're right, but in practicality, it almost never makes sense. David, in one of your old YouTube videos, you stated that trading indices does not get taxed as the same short-term gain. Is this still the case? So David, we're actually doing an event next Tuesday. For those of you that may have already registered for this, for those of you that when you log into OptionsPlay, you'll notice a pop-up to register for this special event on NASDAQ 100 index options. NASDAQ and OptionsPlay is hosting this event together. And we're going to be talking about some of the benefits of trading index options, because one of the benefits of trading index options is the fact that you have what we call tax efficiencies, because index options are taxed at the same, in a taxable account, are taxed at the same tax consequences as futures trading, which is a 60-40, 60% short-term gains, 40% long-term capital gains, which means that your highest effective capital your rate on a short-term trade is only about 23, 26%. So yes, the index options do still provide that tax efficiency for those of you that are trading in a taxable account. If you want to learn more, there's a thing that you can Google. It's called the 1256 rule. It applies to futures trading. It applies to index options, where it's the 60-40 rule, and you can look that up. Jurgen is saying, why is your score 122 higher as the winning vertical with a 99 score? I'm not sure which one you're referring to. If you're referring to this, it really comes down to the risk to reward ratio here, right? So the risk to reward ratio here, I'm risking 128 to potentially make 222. That is fairly attractive versus the 65, 135. So it really just depends on what you're looking for. But again, like I was telling you, even though this has a better risk reward ratio, even if the stock goes down by 11.5, almost 10%, even in that case, you're only looking at about a 9% return. No matter how good the risk to reward ratio is, you still need to have a sizable move before the strategy makes sense. How come you're making us West Coast folks get up at 5:30 a.m.? Bill, I am myself on the West Coast as well. It's because the market's open at 9:30 on the East Coast, and I want to be wrapped up before the start of that session so that you are able to take advantage of it. If you can't wake up, we are recording it so that you can access it. But I myself am on the West Coast, so I will be up at 5 a.m. myself for this session. Is it generally a good idea to buy options around earnings season and avoid it altogether? Is it generally a good idea to buy options around earnings season or to avoid it altogether? So Mohammed, like I said, there are plenty of opportunities where buying an option is the best option when you expect that big move. So think about the stocks that you think are going to make a big move. Someone said Zoom or Peloton before. Those are the types of stocks, if you're playing on earnings, you might be better off buying versus selling options. Do you record these sessions so the members can view? Yes, all of our sessions are recorded. How important is gamma risk on these plays? So Fernando, because we're not holding these strategies to expiration, gamma risk is only something you worry about in the last 2 weeks of expiration if you're short an option that's near the money, meaning an option that's close to the current price of the underlying stock price. Outside of that, when you're trading an option that's 4 or 5 weeks from expiration or really far in the money or really far out of the money, gamma risk is not something that you have to worry about. And if you're just holding for 5 days max, why don't you use a lower expiration? It depends on the strategy that you're trading. So if you're short an option, the reason that we don't use such a low expiration is because of gamma risk. You want to avoid that gamma risk. When we're buying an option, we want to lower volatility, crush, and time decay as much as possible. When you buy a 5-day option or a 10-day option, that's where you have the maximum time decay and maximum volatility crush. So that's why whenever we're buying an option, we like to go further out. Whenever we're selling an option, we also like to go further out because we want to avoid gamma risk. Would not using weekly options bull put spreads profit more from IV spike and crush either vertical or time? No, David, because an out of the money to 30 days support less profit but less risk. David, I'll be honest, I'm not sure I understand your question. If you could clarify or rephrase that, I'm happy to answer your question. Do you use TradingView for chart analysis? I do happen to use TradingView for my chart analysis. I'm primarily interested in learning step-by-step how to trade credit spreads. This is an option that you offer. So I have a whole lot of videos just on trading credit spreads. You can go to our YouTube channel. Like I said, on the intermediate courses is where the credit spread lessons are. So go to our YouTube page and look at the intermediate courses, and we have a credit spread opportunity report that is updated every single hour. You can find out more about that. That is on your OptionsPlay tool at the bottom. As you can see, there's a section called credit spreads, specifically a report just for you to find opportunities to sell credit spreads. So yes, the answer to your question is we have a lot of tools available to help you learn and execute credit spreads. And not to mention, most of the daily plays that we send out in the current market environment, because volatility is high, is selling credit spreads. So the one that we sent out this morning on GLD, that's selling a credit spread to take advantage of a bullish view here on gold. When do you send out the recording of this? We usually always send out the recordings within about an hour of us finishing the recording. So pretty soon after we finish recording. Again, all of our sessions are recorded and are available to you. Is there unlimited risk in a spread or strangle option? So a spread will always have limited risk. A strangle will have, if you're selling a strangle, you will have unlimited risk. PE is potential takeover profit. What strikes and expiries are best? So Tom, I'm not here to provide personal investment advice here. So, I mean, I can only provide my personal opinion on certain things, but I don't know anything about PE's potential takeover target. So, and even if as a takeover target, I don't know that strikes and expirations would change as a result of that per se. You would still trade the same strategies as you would, regardless of whether there's a takeover target or not. Will members be getting a copy of the slides? Yes, we always make the recording with slides available at all times. When is the time spreads? When is the time spreads are appropriate? Victor, I think you mean like when are time spreads appropriate? Generally speaking, time spreads are most appropriate when you expect some type of volatility crush. That's why we're selling that really shorter dated option and buying that longer dated option. So earnings is one of the best times to use time spreads. In your earnings spreadsheet, you do not show if the earnings are announced in the morning or in the market closes. Can you change that? Eduardo, we are in the process of changing that. As you can see, we already have that on the liquidity tracker, so you can track it using this as well, AM versus PM, but we are adding it to the platform next week. I bought a credit spread on Jacob. So generally speaking, if you sold a credit spread well before earnings and it's now approaching earnings, you generally want to close it out before earnings. Generally speaking, Tesla still has 6 days to go, so you have a little bit of time here. But generally, we would want to close them out before earnings. Unless it's an earnings play itself, and that's a different story. But I don't think you entered it necessarily as an earnings play. Are there plans to integrate the dividend spreadsheet into the options play? Jay, we don't have a dividends spreadsheet, but we have dividends already on your platform. So you see it right here. It'll show you the dividend, and if there's an announced ex-dividend date, we'll put it down there as well. Do you have a rule of thumb on using deltas for cover calls? So cover calls is usually about a 10 to 20 delta is the range that we typically use for a cover call. What do you think about BA long calls? So Avi, again, I'm not here to provide personal investment advice. We do these market outlook sessions on Tuesday mornings where we talk to you about our views on the markets. So please join us on that. I can only provide, again, my personal opinion. We do not provide personalized investment advice. If selling a spread, why not use a shorter time period for increased time decay? Great question, Barry. And this is a common, I think, misconception that traders have, that time, if you just have accelerated time decay, that's best for selling strategies. And the answer to that is that in a vacuum, that's true. But what are you trading off for accelerated time decay? Nothing comes for free. The reality is that when you have accelerated time decay, you have elevated gamma risk. And usually in the last 2 to 3 weeks, the acceleration that you're getting in terms of time decay, yes, you're getting more premium per day, but you're taking on substantially more gamma risk for it. And that is the trade-off that we think is not worth it in that last 2 to 3 weeks. So that's why we sell usually 45 days out, because the acceleration and time decay is already significant at 45 days out. But once you get into the last 2 to 3 weeks when time decay in theory starts to really accelerate, so does gamma risk. So we want to avoid that gamma risk more than we want the acceleration and time decay. So that's why we don't use a shorter time period, even though there's a higher time decay. Can you talk a little bit more about using strategies for earnings season? Joseph, did you have a specific strategy in mind? We've covered debit spreads, credit spreads, long calls, long puts, calendar spreads, diagonals. These are all the limited risk strategies. If you want to talk about other strategies that have unlimited risk, you can certainly do that. But we generally don't advocate you take strategies that either have unlimited gains or unlimited losses for the most part. Yes, if you're on a trial membership, you will get access to tomorrow's technical analysis session. If you have an Amazon call option that expires in June, would you sell a call option against it and make more money? So Tom, as a general rule of thumb, and this is not necessarily a comment on Amazon or the strike prices that you have, but as a general rule of thumb, whenever you have a long dated option that's relatively in the money, it acts pretty much like a stock position. And if you own the stock, would you sell cover calls against it to generate income? If the answer to your question is yes, then you should sell cover calls against your long call position. If the answer is no, then leave your long call position. It really depends on whether or not you're comfortable with selling cover calls as a general rule of thumb. Why does it seem like the debit spreads have higher options play scores, yet the credit spread seems like your preferred strategy? Is there something score does not take into account? The score does not take into account a directional bias. The score is only taking into account the expected trading range and what is the risk to reward ratio in all possible scenarios. So there is an intuitive bias to not taking on more risk than the potential reward here. So the risk to reward here in this particular case is not particularly attractive when I'm risking double what I can potentially make. Here, I'm risking less than double what I can potentially make. So that's why you have a higher options play score. It just means that if I was to take this trade 100 times over, I'm likely going to make more money on this debit spread than I am going to make on the credit spread. But that doesn't take into account a directional view, right? And that is also assuming that you hold it to expiration. These are all based on holding to expiration. Now, we're not holding these to expiration. So that's another factor that we have to consider when we're looking at these types of strategies. I'm registered as a member through, so I think I answered that question already. how does Ivy move with unexpected events? Fastly news yesterday. So Fastly, I would expect that even though Fastly, reported earnings, but the fact that the stock declined 25%, this is one of those rare cases where on earnings, not only does implied volatility not come down, it's likely going to be actually more elevated in the example of Fastly. But that's, in my opinion, more of an unusual scenario and that doesn't happen very often. What time do you post a copy of your tomorrow morning session? So usually, again, about an hour after the session is usually when we post those recordings. On the second row of your earnings calendar, you have column headers as, the question was, what does this column here refer to? That just tells you what sector is the dominant sector reporting on that given day. So early in the season, you have a lot of banks that are reporting. You have a lot of REITs that are reporting. These are the types of firms that are reporting early. As you get later into the season, we start getting into the biotech names. And then biotech starts taking over. So a lot of the first sectors are banking, biotech, REITs, these types of sectors. It just gives you a sense for what which sectors are dominant for that given date. Using the standard deviation formula, is that a good way to determine an option move? So William, the standard deviation is a quick back of the envelope calculation. We take a much more robust calculation of trading range. So we use the implied volatility in an option, create a binomial tree off of that, and that gives us the expected trading range. So you can use the trading range simulator, which is a fourth dot from the bottom of your screen. When you click on that, you can select any expiration date, and we'll show you the expected range of that expiration date. So that's a much better way of determining your actual trading range. Which brokerage place do you recommend to trade call or put spreads? So, pretty much any of the major US brokers are suitable, but I trade with Thinkorswim. I have a good relationship with Tastyworks, but we also have a good relationship with Schwab, Fidelity, Merrill, all of these firms. Any US brokerage firm, to be perfectly honest, out of the major firms is suitable for trading credit spreads. Okay. I have covered a lot of questions here already. Let's see if I have a few minutes for a couple of more. Can you explain how you use implied volatility during options trading? So implied volatility is something that expresses how cheap or expensive an option is, because whenever you're buying an option, you're expecting that implied volatility is going to be higher than what the current market is expecting. And if you're selling options, you're expecting that the implied volatility is going to be lower. So implied volatility is a measure or a way to quantify just how volatile the market expects the future of that stock to be. So implied volatility is very useful to help you determine whether you want to skew more towards buying versus selling options, is the best way that I can explain quickly how traders generally use implied volatility. What levels of Vega and Delta justify buying calls instead of selling puts before earnings? So every single stock has its own Delta and Vega. So it's not like there's a level of Delta or Vega that you're looking for. Delta and Vega just tells you how sensitive the option is to changes in the underlying stock or Vega. So generally speaking, whenever we're buying, we generally want to be in that 50 to 60 deltas. Whenever we're selling, we want to be in that 20, 25 deltas. But it really depends on the strategy. So it's not just a specific Vega or a delta that we're looking for. Use butterfly in the puts side and call side with weeklies. So David, I'm not sure how that's a question. If you can clarify, I'm happy to kind of help answer that question. Henderson, you mentioned the impact of Vega, Delta, and Theta on the option prices, but you did not mention Gamma. Is that not also relevant? So Gamma is not really relevant because you're not holding on to an option for very long. It's not, because the Gamma is already built into the Delta. That's why we don't need to really account for Gamma. Gamma is really something that we worry about as you get closer to expiration, because Gamma risk only accelerates if you're trading an at-the-money option in the last 2 to 3 weeks. Outside of that, Gamma risk is not something that we generally have to worry about. Do you ever recommend condor or butterfly trades around earnings to benefit from the volatility crush? So Mark, You can use condors and butterflies, and and many traders do. I prefer to be more on the directional side and use credit spreads, but there's nothing that stops you from using, two credit spreads and turning that either into a condor or a butterfly, but you're still at the core of it trading a credit spread. Can the diagonal be placed well ahead of the earnings date? You can, but I don't recommend it. You generally want to enter it no more than about a week and a half before the earnings announcement. Otherwise, you're just paying for time premium that you don't need to be paying for. Intuitive Surgical reported earnings pretty much in line or better, but Da Vinci's was sold less than expected. Why did the stock react so negatively? So this is really where, like I said, companies, generally speaking, or the stock prices will generally react more to forward guidance than the actual earnings or to profits or revenues. It's really when a company tells, okay, here's what we reported last year, but here's what we expect for the next 6 months or the next year, that is going to generally have a larger impact on the stock price, higher or lower as a result of earnings. Okay, I think I've covered as many questions as I possibly can get to here today. Again, thank you so much for taking your time out here this afternoon and learning more about this. I really thank all of you members for supporting us and allowing us to continue doing this. And that's why we're doing more members only events so that you guys can access more exclusive content, that we spend more time researching, giving you content that you guys are really looking for, and providing you with a smaller forum to ask more questions amongst members here at OptionsPlay. So thank you so much. We're really looking forward to doing more research on that front and providing you understanding as to how the markets work, how you can find opportunities in this market, and we're going to take the time to take more time to research this during our members only webinars. So we're really looking forward to doing more of that going forward. Thank you so much for your support, and we will be sending out the recording with the slides to everyone here in about half an hour or so. So look out for that for those of you that want to watch this at your own speed. Thank you so much. Have a great evening, and I'll see you guys bright and early tomorrow morning at 8:30 a.m. on our technical analysis guide. Have a great night.